Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Glad you are here with us as we talk about financial matters. Myself and my co-host, we're both financial advisors and have been helping people for decades. I've been doing this program for decades and glad you are here.
Yes.
It's funny, we have more podcast listeners than terrestrial radio listeners. But I was thinking, like, how many podcasts? It seems like everybody has a podcast these days. Like, there are so many podcasts.
Like 1 out of 10 people. 1 out of 10 people have a podcast, and 1 out of,
I just thought how different it is compared to years ago when
But did you remember, like, we were meeting with the marketing people, and they're like, "Oh, your podcast is in the top 1% of all podcasts in the U.S." And I started laughing.
there's 100 million podcasts.
I go, that's like being the smartest 15-year-old in the third grade. I mean, it doesn't mean anything.
Anyway, so we appreciate folks listening to the program. We'll take some calls, and we've got some good content as well today. And Pat, as we get, I want to.
Okay.
I think there's a transformation. There is a transformation that's going on in the fixed income market. The way companies borrow money, the way investors provide the money to those companies, it's changing. And so
it's not even the bond market, it's becoming the fixed income market.
The fixed income market. And it's going to have implications for all of us as investors. It already has implications.
All right, well, let's start with the basics, Scott.
That's why I'm going to go with this. So if you think historically the way companies raise money, the way the government borrows money, it's by issuing bonds. And we're going to be real basic here for a minute. Let's say that the U.S. government goes out, this is what they do all the time, they issue a 10-year bond. And as an investor, you think, I'm comfortable with the interest rate. Rates today are roughly 4.5% on a 10-year treasury, give or take. So say, all right, I'm going to buy one of these bonds, and let's say I'm going to buy a $100,000 bond from the U.S. government. The government's borrowing money.
I'm lending $100,000, and in return, I will receive $4,500 a year in interest for the next 10 years.
That's right, 45. So that's 4.5% of the $100,000.
And at the end of 10 years, the assumption is that the U.S. government will still be intact and have the ability to pay me back my $100,000.
So you get the $100,000 back at the end of 10 years. That's how a bond works. It matures. That's the maturity date. And the reason the bond values will fluctuate quite a bit, let's say in this example that I went out in the market and bought a bond at 4.5%, and I was quite happy with my $4,500 a year in income. And 2 years later, the market has changed, and Pat goes in the marketplace, and they're now paying 6%, and for his $100,000, he's getting $6,000 a year in income, and I'm thinking, dang,
I want that $6,000.
I want the $6,000. I'm only getting $4,500. Pat, would you buy this bond from me? And Pat say, I'll buy it, but I'm not going to give you $100,000 because for $100,000 I can get $6,000 a year in income. Why would I give you $100,000 for something that's only 4.5? I'll give you $82,000 or whatever the number. So the math all works out.
So that my yield is 6%. My yield, I paid less than what's called face value. My yield is 6%, but at the end of that 8-year period, we still have 8 years left on this bond.
That's right.
I will get $100,000 back for it. So that's all computed into the price.
Which is why the longer that bond, right? If the bond is going to mature in 2 weeks, well, I get my $100,000 in 2 weeks. Whether I'm getting 4.5% or 6% for the next 2.5 weeks, not that big of a deal. If it's 30 years, it can be massive.
Big
so
deal.
they get huge swings, which is why we talk about as investment advisors about duration. How long of our bond portfolio do we have in our portfolio? And the longer that duration, the longer those bonds are, the more volatility, the more fluctuation you're going to have in the value of your bond portfolio. Now, you might say, well, Scott, it doesn't matter because I hold mine to maturity. Well, it does matter because they get priced every day. And just because you decide to hold them to maturity doesn't mean that the value is not real. So
because it is real.
It is real. When people talk about a paper loss or paper gain,
Money's paper.
that's the last I looked. Money is like it's all
It matters.
It matters. So this is historically how the governments raise money and companies. And companies, with the other twist besides the duration, it's how likely is that company going to be able to pay me back?
Or it's called credit quality.
Right? So, yeah, I'm going to loan, instead of the government $100,000 for a 10-year bond, I'm going to loan Apple $100,000 for the next 10. I don't know what the interest rates are in Apple bonds, but let's just assume
It's pretty close to government.
it's going to be a little bit more because there's a little more risk. They can't print dollars.
But it's going to be pretty close.
It's going to be pretty close.
But what if I was lending the money to, Joe's Crab Shack? That's a small little organization, has 6, and their financials are in a mess.
And then you're like, I know you're doing fine now, but 10 years out, who knows?
Yeah. What happens if the price of crab doubles and you can't sell anything?
So you're going to command a much higher price.
Because of the risk.
Because of the risk. So in that situation, we have still 2 things we're dealing with, right? The duration, how long that bond is before we get repaid. If Joe's Crab Shack, we know they got money and they're going to pay us in 2 weeks, we're probably not that worried. 10 years out, we might be concerned. And there's no attack on Joe's Crab Shack.
I'm sure it's fine. We'll call it Jimmy Joe's.
Jimmy Joe's Crab and Shrimp
Okay,
Shack.
there we go.
So there's the duration. There's also the risk of the ability for these companies to be able to repay. That's the credit risk. And so this is how a lot of money is raised historically. What is happening?
And let's point out that the bond market is massive.
Larger than the stock market.
It's massive. The problem
and highly
is,
fragmented.
the problem is it's not quoted the same because every bond is a different issue with a different date and different maturity. Some actually are in layers, so they might have more risk than ones that sit just next to them from the same company.
And every January 1st, there is a composite for the 10-year Treasury, and you can track that. But that's about it.
It's not like there's an underlying index of there are underlying index, but they're not quoted like the Dow, the S&P, and the Nasdaq.
That's right. A little harder to track. But what we've seen more of is these private markets. So companies that historically would have raised money through bonds, they would have been perhaps junk bonds because they didn't. And junk bond, all that means is their credit rating is not as high as. Gosh, I'm saying this. I wonder how many of the listeners actually think about junk bonds
Nowadays?
Yeah, nowadays.
Unless they've started watching financial movies from the 80s.
I mean, I kind of grew up in all that stuff. But junk bonds, it just means you don't have the highest credit rating. There's a certain, if it goes below a certain level, you have to pay higher. The Jimmy John's Crab and Shrimp Shack example. But what's happening now is they're not going to the bond markets like this, where it's sold through intermediary. Rather, they are borrowing money for these private companies, private equity firms,
like BlackRock.
They raise capital.
Capital.
They raise capital. Then they go and loan it to companies. And the terms, it's not one is the maturity date may be very different. Second is the interest rates are typically tied to a current rate. Think of them like an adjustable rate mortgage, a floating rate.
But part of that is based upon your performance as a company. So these groups that are buying in have visibility into your financials, and if you start doing poorly, they're allowed to move the interest rate.
They have all kinds of covenants and restrictions come with these. But
it's called the private credit market.
Private credit market. But with that, companies, rather than having a guaranteed fixed rate for the next 10, 20, 30 years, it's a rate that floats based upon where short-term interest rates are and some margin. So as an investor, one of the things that some investors like about this, like I know I'd like some money that's in fixed income. I don't like the whole concept of long duration and interest rate risk, the interest rates. So having rates that adjust with current rates is kind of attractive because now you've taken that one piece of risk, that whole duration risk, off the table.
And you've taken a portion of the business risk off the table because it's based on performance. So if you don't hit your covenants, they can raise the interest rates on you.
Well, that's correct, but they can also, there's still you might have the inability to repay.
Well, I'm not discounting that.
And like a lot of leveraged buyouts, this is how a lot of leveraged buyouts are financed. A lot of M&A
So your premise is that this is where the industry's going, or is gone?
I think we'll see more and more of this direction. But where we are now, the way that's structured is like right now, any individual investor, you can go buy a bond, an individual bond that's in the marketplace. You might pay a little bit of spread or pay a little commission depending on where you get it. It's not going to be that much. These private markets, not the same kind of market.
You don't know what it is.
Instead, as an investor, you say, well, I'm going to give my money to some company. You mentioned a few there. I'm going to give my money to some company. I'm going to tie my money up for some period of time. They're going to then go out and loan to these various companies. And so we are seeing the emergence of products designed for the everyday investor to invest in these private credit markets, but they're not quite like buying a bond fund, because you can buy a bond fund one day and sell it the next day.
These,
typically, your money's tied up for a period of time. Sometimes they're called interval funds, where your money's going to be tied up, and maybe you can only redeem or sell some of your shares on a quarterly basis. And it might be highly restricted to how many people.
We only let 5% of the people.
It prevents a run on the bank,
That's
essentially, right?
Do you think this has anything to do with the lack of confidence in the bond rating firms?
Well, the bond rating firms are rating these same private companies.
Understand.
It's a big business for them.
Understand. But they're not rating the individual holdings inside of those. They're rating the overall portfolio. That the investor had lost confidence in a bond rating company for that piece.
I don't know. I mean, the conflicts of the bond rating companies.
I mean, we saw that during the mortgage crisis.
It still exists. You want to get a rating? You want one of the big firms to give you a rating? You have to pay. You pay them, and they will give you a rating.
Yeah. Yeah. I mean,
how bad a rating they're going to give you? Oh, we just got 130,000 from this company. They want a rating on this.
And they go into a back room.
Debt.
And there's this wheel, and they spin it.
That's not quite how it works.
But there's some. Also, there's because they're private credit. You're not underwriting a bond issue. Smaller companies can go to market and borrow money more easily than they were previously because they're not doing big bond issues. The private credit companies will
private markets to those companies. It's much
smaller, much easier. Yeah, the access,
and they've actually displaced a lot of where the banks used to be the lenders, because now you don't go to bank, you work with one of these third-party companies.
Yes,
that are structured similar to the way say a private equity fund would be.
So it's good.
It can be,
and
it can be bad. I mean, look, we use them.
Maybe it obfuscates risk because of the fact you can't run on it.
Well, that's clearly the part of the discussion of that, right?
Right.
But with any sort of investment product, just be careful. Don't overweight your portfolio in any particular area. Make sure that if you invest in one of these, understand what your limitations are. I think they're
what the restrictions. But Scott, these have been around for 30 years. The problem was, I remember these guys calling on us 25, 30 years ago and telling us about these interval funds, and you could get to 10% of it, and it opened up every quarter, and this and this. There wasn't enough visibility into them for us as advisors to feel comfortable with.
That's it. Well, and the markets were much smaller.
That's part of that is that there were other places for these companies, more established companies. But as the market grows for private credit, it brings in more borrowers that are higher quality, not lower quality.
But they can get very expensive too. The way these are structured, particularly if you're a smaller investor and you're buying into a fund, the fund then goes out and invests in these different private equity companies that are the lenders here.
Yes.
It creates additional layers that there's additional costs associated. So just be really clear-minded, understand what it is you are buying, or understand what it is you're being sold in many situations. So
Or pitched.
yeah. Anyway, let's go to the calls. If you want to join us, questions@moneymatters.com will get you on the show. Again, that's questions@moneymatters.com. Let's talk now with Sue. Sue, you're with Allworth's Money Matters. Hi, Sue.
Hi, how are you doing?
Fantastic.
What can we do to help?
I just have a quick question. Right now, I'm sure I'm like a lot of other people where my husband and I have been retired about 10 years. We have our investments pretty well evenly distributed between stocks and bonds, and then about 10% in cash.
When you say evenly, like you're roughly 45% stocks, 45% bonds, 10% cash?
Correct.
Okay.
Correct, yes. And the question I have is, in these volatile times, what can we do to protect against all of these ups and downs?
And how old are you guys?
Late 60s, early 70s.
Okay. And did this money, did you save this up over a period of years through your employer 401k or?
That's correct, yes.
And as a percentage, how big of a distribution are you taking?
Right now, RMD on my husband, who's a bit older.
Okay. And nothing on yours?
No.
Where's how are you surviving cash flow wise? Do you have pensions or Social Security?
That is correct, yes.
So, and the reason I ask these questions is because I want you to think back about how you accumulated these dollars, right? You've been working presumably the last 40 to 50 years, and you've been saving a little bit the whole time. Is that correct?
Yes.
Through volatile markets.
Through volatile markets. Had you ever changed your portfolio before based on what you thought you saw in the environment that was going to change for you? Like, have you ever gone to all cash or all stock or?
No, my husband was smarter than I was, and before 2008, he made some changes, so he didn't lose as much as I did.
Okay.
Well, you only lost in 2008 if you sold.
Yes. So
if you just held the broad markets through,
you were further ahead than he was.
Yes.
most likely
today. Yeah, today.
So here, there's all kinds of rules of thumb, but every situation is unique. And here's what I see, and we haven't talked about your heirs yet, but your situation, your late 60s, you aren't reliant upon your life savings for your income. You've got income from other sources.
We know that
Correct.
because you're just taking RMDs.
So if you called and said we're taking an 8% distribution and we have 80% in stocks, would probably like whoa, like. But you're in a situation where you've got the luxury. Frankly, you've got the luxury of doing whatever you want with these dollars. You can stick them all in cash and say I'm just gonna not worry about it anymore. You can put it all in stocks if you want and say we're only living on the required minimum distribution.
You could put them all in small cap growth stocks.
You could pick one particular company if you want. And the reason we say that is you're not relying upon this for income. So the question is, what is your intended purpose of your saved assets that you're not using for your income?
Well, I figure that inflation is going up faster than our income. So at some point we will be relying on it.
Okay. Well, then
I like the way you're thinking.
and then
I would agree with you.
And then your portfolio is perfectly balanced for that. So, but the question you had was, should we change because of the current environment?
There are some strategies you could employ. They are not going to increase your return whatsoever. They will reduce your return over time. So whether it's using some sort of options to give you some downside protection, there's a cost for those things.
But you've lived through recession after recession after recession.
If you were taking a large distribution on this, I'd be, well, a little more empathetic. I don't think I would recommend any changes. You've got a relatively small allocation. You're less than 50% in equities. And if you look at a married couple age 65 today, there's a 50% chance that at least one will still be alive at age 90, right? So odds are at least one of you is going to be around 20 years from now.
So you're going to need that for inflation. I like the way you're thinking. I wouldn't pay this is hard to say because it's hard to do, any attention to what's going on in the economic environment. I was thinking, last time we did the show, Scott, you talked about AI, artificial intelligence.
Briefly. Just being a complete tailwind to the economy.
To the economy, right? So we might be going into a recession. We might be going into a hyper-growth area of the economy as well. We might be doing a combination of the two of the things. In some industries, we'll be in recession. In others, there will be hyper-growth. But the reality is we get clouded by this political environment in which we live. But businesses have operated in political environments since the beginning of time.
With all kinds of crazy stuff have to navigate through. Look how well companies navigated through COVID.
Look at how well companies navigated through World War II.
Yeah, ingenuity is amazing.
And so that's kind of what you're betting on over the long term when you're buying stocks or mutual fund or broad index. You're betting that American or ingenuity in general is going to provide you with some balance. And the reason we do balanced portfolios, widely diversified, is because we know some of them are going to be wrong, just flat out. But I think your portfolio is perfect.
Okay, well, that's really good to hear.
Scott, I wouldn't worry about it at all.
Correct.
Okay.
Not even a little.
And look, historically, stocks, like we hear the term bear market, it's typically defined as a decline of 20% or more in the stock market, which is a lot, right? 20% decline. Historically, that happens about once every 4 years, a little less than that, about once every 4 years. Actually, we just went through it on an intraday basis last month.
Yes, and it was over pretty quick.
Right. If you were on a long vacation, you would have missed the whole thing. But look, there's been longer ones too, right? So the financial crisis was a horrible time to live through. But I think it comes down to, like, what is your approach to investing? Because it's so tempting to say, let's get invested when things are going to be good, and let's get out when things are going to be poor. But there's no way to tell these things. And if you look historically, there's been nobody, the best experts, with the most brilliant minds of the best mathematicians on the planet working for teams cannot outsmart the markets.
Yes. Remember the big where the quants were going to own the market? This is my quant. Remember that? Long-term capital? Was that the one?
Yeah, that was a long time ago.
That was a long time ago. You're great.
98, I think.
You're great. You're a good saver. You're relatively, it sounds like you don't overspend. You're great.
Yeah, I wouldn't worry. And when it goes down, the way you get returns higher than cash and bonds is through those ups and downs. So next time it goes down, you think, stocks historically have done about 10% a year, about 7 percentage points above that of inflation. That's what your concern was. They have done 6 or 7 percentage points above that of inflation over the last 100 years. Not every year, obviously, but so when it goes down, a big day and the news makes it sound like it's different this time, like, just remember, wait a minute. This is what I have to go through to get those excess returns.
It's called a risk premium. Your premium that you're paying is the added volatility risk above that of the short-term treasury. That's how it works. So appreciate the call.
Yep. Wish you well, Sue. Essentially, Pat,
thank you.
Thank you. I was at a conference a bit yesterday, and the presenter, he talked a few different times about. He's one of these guys that I could just tell he thinks he's outsmarted the market, and he mentioned Warren Buffett a few times throughout the day and what Buffett has done. I'm thinking, Well, what Buffett did to build his wealth 30, 40 years ago is different than what the world today, number one. But one of the things he said to me, he says about interest rates, and he made a case why interest rates are going up and made a prediction on what the next couple of years are going to be like in the markets.
That's bold.
Right. And here's the federal deficit and where the deficit is. And the recent downgrade we had, we were already downgraded by the other agencies, and one more agency decided to throw in the towel. Look, I'm thinking, how in the world does anybody know where interest rates are going? Because the interest rate today, you look at the 10-year Treasury, Pat.
Yes.
Say 10-year bond, right?
You're
So
loaning money for 10 years.
the price is set by what you believe is going to happen over the next 10 years. And so if today people are saying, the average investor is saying, we believe the rates are going to be 4.5, we're willing to accept 4.5% return over the next decade, which is give or take where the rates are. Like, why are you clairvoyant? Why do you have the ability to say, no, rates are going to be 7% or rates are going to be 3%? Because the market has already taken all the information that's out there and priced them in.
Yeah, correct. It's collective. But you've worked with me a long time, a little cynical.
35 years.
I can be cynical. In fact, I think a good investor is cynical, which therefore I'm a good investor. But sometimes I think these people actually talk more about that garbage just to draw an audience than they do actually believe it themselves. That's
not this guy.
Really?
No, he was making a whole business case why the next couple of years are going to be good, and then it's not going to be good after that.
Oh, he actually could tell you when the cycles are going to happen?
He had it written. He had it written for the next 4 years.
No. That's awesome.
And he talked about with the what are the next election cycle called? The
midterms?
Midterms. I was going to say interim, but it's not interim. Midterms. And I'm like, well, then the midterms, because the Democrats are going to win back the House.
Okay.
And so what this is going to mean, and then he drew on the graph, the economy going down, and I'm watching this thing going, wow.
Wow, that is something. That is something. Did you stay? Did you sit through
Oh, it's a long story. I'll tell you.
Oh, yeah, you got to tell me. No. Did you sit? You sat through it. I'm sorry you had to sit through that. I'm sorry you had to sit through that. That's hard to watch.
The rest of the material was actually really good. It was just the one going off on these tangents of predicting the future.
You mean his source material was educational?
Yes,
it was
when he went off script and started doing this sort of stuff.
And his opinions were bad. Well, they might be perfect. We don't know.
Maybe he was 100. Maybe it's 100% right.
Yeah.
Maybe I should have taken some pictures of the graphs.
Midterms. Actually, I think you could make more money on betting on the midterms this far in advance than you could on the economy.
I don't know.
Well, I think if you could call the midterms exactly for each house,
I mean, historically, the other party wins back the House.
I understand, but there's a huge market of betting on.
I know.
Could bet on.
It's probably more fun than trying to pick the best stock over the next couple of years.
Yeah.
Anyway, we're talking now with Tim. Tim, you're with Allworth's Money Matters.
Hey, how you doing?
Hi, Tim.
What can we do to help?
I guess. Well, I guess I could say I need a lot of help. I'm not like the usual individuals that will call in, and it seems to be like they're pretty set and secure in life. First of all, it's really an honor just to be able to talk to you. My dad would be very happy. He listens to you every Saturday, the both of you, and he taught me a lot. So I wouldn't be where I am without him, and he's definitely got that information from the both of you.
Oh, I appreciate that.
So
when you say you say you're just starting out, right? We all start somewhere. Let's go with that premise. Tell us where you're at, and tell us where you're trying to go.
Well, I was, let's say, I guess it's trying to make a long story short, but I'm in my mid-40s, which is hard to believe. Looking in the mirror every day, a little more gray. But I've actually I was incarcerated for over 20 years since I was a teenager.
Wow.
And I'm re-entering this world really like left behind and without anything. It's like I said, I don't have or initially I didn't have the IRA or the job or the sense of security or even establishing a home
Yeah.
and credit. So having to start life over or begin life at 44, I've been in a blessed position with my family, and not everybody has that opportunity. But I want to be able to take everything that I'm learning and give it to people that don't know.
Okay. Keep talking.
So I do have a job. I have a wonderful job. It's paying quite well at the moment. So I've just initially.
What kind of work is it? Just out of curiosity.
It's a nonprofit in the Bay Area, assisting vulnerable populations, homeless, hospice, formerly incarcerated. Working with corrections, working with.
So you say you're starting out, but in reality, you're using your experiences over the last 20 years to serve others. Would that be fair to say?
Yeah. Yeah.
And so now you're worried about your financial side of things and saying, how do I get this part of my house in order?
Yes, it's expensive. As the world is expensive, burgers aren't $2 anymore. They're $14, and so I just want to kind of set a plan in place, a plan in motion, and it's hard for me to be able to, I don't want to say trust others, but relinquish the things that I've built and give to others to control, would you say?
Yep. So when so obviously it starts with a base, and the base is your income from now, right? And whether you're 20, 30, 40, 50, that's how it starts, right? You've kind of, you have a great attitude about it. How much money do you make, and how much do you think you could save on a regular basis?
So like I said, I'm in a blessed position. I don't have my own place. I'm not renting. Actually, I'm living with family. I'm doing what I can to. So I make about $70,000 a year. I have a 403B with our organization. There is no matching, so it's all me.
Are you contributing to that? Are you contributing to the 403B?
I am.
How much you putting in?
I am.
As a percentage?
$200 a month.
Okay.
But I'm also opened up my brokerage with Charles Schwab. I have mine that I'm kind of playing with, but I also set up a Roth IRA. So last year I put in $7,000. This year I'm going to put in $7,000, but I'm going to put $700 a month rather than one lump sum
into your Roth IRA.
Yeah.
It's above the limit.
Also,
it's 7,000 this year, isn't it?
$700 a month, which would be $8,400 a year.
Well, I want to max out at 7,000.
Okay. Well, okay, but you said $700 a month, so the quick math said it was about the limit.
It sounds like you got things rolling pretty well. So, how could we be of help?
Man, I listen, and I try to gauge and understand. I just don't know if I'm doing the right thing.
No, you're doing great. You're doing great. Look. The reality is, right? The reality is you've started late, right? But what you did yesterday, it doesn't define you the rest of your life. And so you're doing everything you can do. You're saving. Just save as much as you possibly can. I mean, that gets down to, if you could increase your 403B contribution a little bit, that would be great. But just save as much as you can.
And the thing we like about 403B, it gets sucked out of your paycheck before you have a chance to spend it.
And then you talked about trusting others. You're calling the shots on these things, right?
Yeah.
And it's, look, you're in an accumulation phase. You just want to be as aggressive as you possibly can be in terms of equities, and don't get sucked into the fancy stuff. That's where people actually screw it up. I mean, look,
they think they're going to catch up I better catch up, so I'm going to invest in this particular stock, or by the time you know about the stock, it's already run up in price.
I saw an ad yesterday I saw an ad yesterday from a financial advisory firm. Some, when you click through, and their premise was this person retired with $750,000, and they were able to increase their income because of their investments an extra, not the amount, an extra $7,000 a month.
Oh, come on.
That's what it said. And so you're like, okay, let's assume they're taking a 4% distribution and another 7,000. You're thinking this is just crazy. This is nuts.
They're not a real investment advisory firm
That's
there's laws around that. So they're probably not even securities licensed or registered investment advisor.
Exactly. And then my point being is don't get sucked into the quick and easy where people really do blow it. And I've seen them blow. I just think so often about the run up to 2008 when real estate was on fire and you couldn't go wrong, and they'd lend money to a donkey. They didn't care. And I had so many clients take all their investments and say that I did not understand that real estate in Florida was the place to be, Pat, because and I just
it's all those things. And you're going to build. I mean, you've got 30 years, 25 years. I mean, in a perfect world, you've got a job where you're not dying to retire, right? You're like, you continue to enjoy what you're doing. But there'll come a time in life when you're going to need to start slowing down. If you can save as much as you can for your retirement, and then, wealth is really built upon a couple things. One is how much you save, but secondly, it's based upon your career and what you earn. So the reality is, like, you might have the best job in the world. You might love what you're doing. Maybe this is exactly where God's called you. This is exactly where you're supposed to be, but you're not going to get rich there, right? And so everything in life, there's trade-offs in everything in life. And so by choosing the career you've got a decent income, but living in the Bay Area doesn't go very far, right? Like it costs you $8 to drive across the bridge. So it doesn't, it just doesn't go that far.
But if you move to somewhere out of the Bay Area, a small town in Colorado, right, and had an executive level position in a similar nonprofit, it would move you incredibly through. So the other thing is invest in yourself. In fact, when young people come to Scott and myself, which happens because we have kids that are anywhere between the ages.
Yeah, that's right.
And their friends will oftentimes, and they're like, what's the best investment? And what's your answer, Scott?
Yourself.
Yeah.
Not XYZ stock.
No, it's yourself.
It's
Yeah, so
yourself.
I don't want to lose my soul in the process, believing that money is
That's right.
the priority in life, and it's not. I just want to be able to have this sense of security, live way beneath my means, and just have that everyday security. Like I know I'm going to have food. I know I'm going to be able to help other people. I know I'm going to be able to donate. So I guess that was another question. And so in these last 2 years, I've been able to save $100,000.
Holy smokes! Wait, stop! That's the mic drop. We're done. You're fine.
How in the world
So
you save
it depends
$100,000?
Well, I'm living at home.
Okay, well, it is
I
what
know,
it
but
is.
still.
That's a lot. That's
Phenomenal.
It's $70,000
Holy
a year income. That's amazing. Okay, so keep
I
going.
Tim, you're doing
So-
really well.
So I guess another question is, I don't want it to sit in the bank and accumulate nothing and give me pennies in a Wells Fargo savings account
Okay, yeah.
when I should have made a different decision and made.
Shoulda, woulda. It doesn't matter. We're here today.
Yeah, but we go the right direction now.
I would put the maximum you can in your 403b.
100%.
I would maximize your 403b.
Yes. If
And
you're
if you
saving
have
that
to,
much money,
if you have to start spending down your savings to make up for it, then fine.
yes.
I would put
So what
them.
about like a high yield savings account?
Well, that's easy. I mean, that's easy.
Yeah, you should do that.
Yeah, that's
as
easy.
well.
Yeah. You should do that, but you should maximize your 403b. If you're saving that much money on an annual basis, you maximize your 403b,
Your 403b and your Roth
IRA, and then after that, just allocate money to a tax efficient account as well. And then,
Like a broad stock market index,
Yeah.
a total stock market. You could put some in a total stock market, but it's got to be there. That's anytime you put money in something like stocks, it's 20-year money. It's Tim's old age money, right? Like
Right. It's 59 and a half, right?
well, that's the earliest, but I mean the reality is you're 44 and you're probably not going to be retiring at 59 and a half.
Yes, yeah. You're going to work probably until you're at least 70, but at these savings,
I'm 58 and a half, and I don't like the concept of retiring at 59 and a half. So
your saving rates, you're doing phenomenal.
Yeah. Well, I mean, it's not going to be forever, and I imagine it's going to end next year. And so I wanted to see what money am I going to need to be liquid in order to
maybe
purchase, a condo.
Okay, well, that's something completely different, right? So if you said I want to purchase a condo in the next 3 to 4 years, I'm going to say, well, not in the Bay Area, not on $70,000 a year,
yeah.
right? But you've got it together. You're doing great. You should be proud of yourself. You really should.
No kidding. My guess is, not my guess. You are a complete outlier.
Yeah.
Well,
there is that big organization down that works with previous in San Francisco that has the restaurant, the auto repair shop. Are you involved in that group? What's it called?
I have no idea.
I've eaten at the restaurant.
Is it the Delancey Street?
The Delancey Street, yeah. Are you involved with them?
Yeah. No,
Okay.
I'm not.
Yeah.
Yeah.
Anyway.
Anyway, you're doing great.
Yeah.
Yeah. Yeah, but it's just, other than my dad and, listening to you guys, there's no sense of a real education out there for somebody like myself.
No, wait, you're more.
what do you mean
Wait, no,
education?
you're serious. Look. You're in the top 20%.
Yeah.
You know that most Americans, half of Americans, listen to this, half Americans don't have a dime saved.
And they haven't spent any time in prison.
Yeah.
You're in the.
There's the part of America that we look at and say, wow, they've got lots of assets, lots of capital, lots of saving, but there's a whole half of America doesn't have anything saved.
Yeah, you should be proud.
People work their whole lives, get to the end of life, and they're dead broke.
We're not ones for false praise. You're doing
should
doing
feel-
great.
you
You
should
should feel
feel-
good about yourself. Truly. So appreciate the call.
I mean, yeah. No, it's just, just always want to be challenged and,
Well, you're doing
whatever,
great.
whatever
Well,
you
and
learn,
I
just
mean,
being
and-
able to pass it down.
And talk to other people like us and listen to podcasts, and you'll learn more than you need. So glad you called there, Tim. And we're getting near the end of our program, and I'm going to let Pat, you're sticking it in my face. Where'd that thing go?
I might have it.
You've got my little sheeter.
Yes. We can both talk about this.
Okay. Our June webinar. We do a lot of education. Look, we've been an education-focused firm really since day one. Pat and I started doing this radio program, back in 1995, 30 years, and we've done thousands probably of live events and
A fair amount.
webinars and everything else. And a lot of it, we believe that the more one understands there's situation and their options, the more informed they are, the better decisions they will make, and the better financial life they're going to have, which is really what our objective is. So this is a June webinar. It's for legacy planning for high net worth households, and whatever that means. But for this particular, if you've got $2 million or more of investable assets, and you're wondering about how do you make sure that this is structured in such a manner so that it's the most effective way to transfer what's left upon your death, because you probably more than you're going to spend your lifetime, you want to leave something. It's effective strategies for that. And we have two presenters, both excellent. Simone DeVeni, who's Allworth's head of private wealth strategies, and Richard Del Monte, advisor partner in Bay Area Walnut Creek office. They've both been guests on this program. They're going to doing the presenting. And these webinars are Wednesday, June 11th at 10 a.m. Pacific, Thursday, June 12th at noon Pacific, Saturday, June 14th at 9 a.m. Pacific. And to register and more information, just go to allworthfinancial.com/workshops.
I'd take it one step further. For those people that have $2 million, or if you think they're going to have it in the next couple of years,
Fair enough.
right? Truly.
Or if you get $20 million.
Yeah, or 20 or 30 million, whatever the number is. Or you're just overall interested in this stuff.
Anyway, that's all the time we have. We'll see you next week. This has been Scott Hansen and Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.